For years, Americans have relied on the used car market as their financial safety net. When new cars got too expensive, used cars were supposed to be the affordable alternative. But now, that safety net is breaking apart, and the company that once dominated the space, CarMax, has just confirmed what many feared. The market is collapsing faster than anyone imagined. In a single day, CarMax stock plummeted by 47%, wiping out $3.2 billion in value. For a company that built its empire on predictive analytics, smart pricing, and a reputation as the Amazon of used cars, this wasn't just a bad quarter, it was a financial earthquake. Even CarMax's own CEO, Bill Nash, admitted to analysts he cannot predict what's coming next. That's not corporate spin, that's a white flag. And when the biggest used car retailer in America throws up its hands, the entire industry feels the aftershocks. Why this collapse matters. CarMax isn't some small-town dealer. It's the largest used car retailer in the United States, moving over 1 million vehicles annually through 240 stores in 41 states. When it sneezes, the rest of the industry catches pneumonia. Carvana saw shares fall 12% on the same day. Vroom dropped 18%. Even AutoNation, a giant in both new and used vehicles, lost ground. This is a domino effect in motion. When one major player stumbles, it exposes the vulnerabilities of the entire market, from Wall Street investors to the family signing a car loan. The broken math of used cars. Let's talk numbers. Take a $26,000 Honda Accord at CarMax. On the surface, it looks reasonable compared to a $48,000 new car. But here's the catch. If your credit isn't perfect, you're staring at a 22.95% interest rate. That equals a $668 monthly payment. Stretch that across 6 years, and you'll pay nearly $48,000 for a car that was worth $26,000 to begin with. That's not just inflation. That's financial quicksand. Expert insight. Jonathan Smoke, chief economist at Cox Automotive, has warned for months that auto loan terms have reached unsustainable levels, with longer loan durations, higher interest, and ballooning negative equity, turning what used to be a financial tool into a trap. For many families, the car in their driveway is no longer an asset. It's a liability dragging them underwater. Defaults and repossessions. The harsh reality. The pain is already visible. In 2024, auto loan defaults topped 2.3 million. Repossessions hit 1.73 million, the highest since the Great Recession. Miss a few payments, and the repo truck isn't just prowling back alleys, it's pulling up to suburban driveways. CarMax itself has admitted the danger. Its finance arm set aside $101.7 million for loan losses in early 2026, up 25% from the year before. That's not a rounding error, that's a red flag. Expert insight. Patrick Anderson, CEO of Anderson Economic Group, told Bloomberg, when defaults accelerate this quickly, it's not about bad borrowers, it's about a system stretched to breaking. Why dealers are dumping cars on CarMax. CarMax isn't just struggling with its own loans, it's also becoming the last resort buyer for other dealers. Dealer-to-CarMax sales are up 38% year over year. In previous quarters, that spike was even higher, up 46%, and before that, it more than doubled. Why? Liquidity. Dealers are drowning in floor plan interest, the financing they use to hold cars on their lots. Every day a car sits unsold, interest piles up. Add in auction fees, up 50% since 2019, and shipping costs up 30%, and holding onto inventory has become a losing game. So dealers are dumping cars on CarMax just to free up cash, even if it means selling at a loss. Expert insight. Michelle Krebs, executive analyst at Cox Automotive, explained it bluntly. Dealers are in survival mode. It's not about profit margins anymore. It's about paying off lenders and keeping the lights on. The negative equity tidal wave. Perhaps the most alarming sign is the surge in negative equity. 24% of all trade-ins in 2024 came in underwater. The average amount owed beyond a car's value, $6,838. This isn't just luxury buyers or people who splurged on EVs. Everyday families are rolling debt from one loan into another, sinking deeper each time. Some owe $10,000, $15,000 more than their cars are worth. Expert insight. Edmunds reported that negative equity has reached the highest levels on record, calling it a rolling snowball of debt that threatens long-term stability in the auto market. The result? Millions of Americans are locked into cars they can't sell, can't trade, and can barely afford to repair. Banks are slamming the brakes. Lenders aren't blind to this storm. They've already begun tightening credit. Approval rates for challenged borrowers have plummeted. Dealers are getting calls from banks demanding cash or collateral. Floor plan financing, once cheap and easy, is becoming scarce. Expert insight. Mark Zandi, chief economist at Moody's Analytics, put it simply, the risk tolerance in auto lending has collapsed. Banks are pulling back, and that accelerates the downturn. This credit freeze is what transforms a market correction into a full-blown crash. With fewer buyers able to finance, cars pile up on lots, prices spiral down, and desperate dealers offload at a loss. Why cash buyers are in the driver's seat? Here's the silver lining. If you have cash, this market is your playground. Tariffs have pushed the average new car price to $48,000, putting it out of reach for many households. But with credit tight and repossessions flooding the market, cash buyers suddenly have leverage dealers haven't seen in over a decade. Instead of chasing approvals, a cash buyer can walk into a dealership and close on the spot. Negotiate deeper discounts on cars dealers are desperate to unload. Take advantage of wholesale pricing without the risks of financing. Expert insight. Carl Brower, executive analyst at IC Cars, summed it up. Cash is king again. If you've got liquidity, you can name your price. CarMax's risky playbook. To cope with the turmoil, CarMax is moving risk off its books. In 2026, the company bundled $637.9 million worth of non-prime loans and sold them to investors, freeing up $26 million in reserves. That's a short-term bandage, not a long-term cure. Offloading toxic debt might buy time, but it signals one thing. CarMax expects defaults to keep rising. Meanwhile, the company is betting on growth in dealer-sourced inventory, expanding reconditioning centers, and positioning itself as the buyer of last resort. But this strategy depends on the very thing that's killing smaller dealers: their desperation. If the wave of failures continues, CarMax may end up drowning in the inventory it thought would save it. The road ahead, how deep does the crash go? So, where does this end? Best case scenario, used car prices stabilize as repossessions flood the market, bringing affordability back for buyers with cash or good credit. Worst case scenario, defaults accelerate, lenders tighten further, and dealers, both small independents and large chains, collapse under the weight of unsold inventory. Expert insight. Scott Keogh, CEO of Scout Motors, recently commented at an industry roundtable, "We're witnessing a structural reset in auto retail. The next 18 months will separate survivors from casualties." For CarMax, survival means adapting to a market where easy credit is gone, margins are squeezed, and even its vaunted data models can't see around the corner. What this means for consumers. If you're shopping for a car right now, here's the reality. If you need a loan, you'll face high rates, stricter approvals, and a real risk of going underwater. If you have cash, you're in the strongest position in years to negotiate. If you're already locked into a high-interest loan, refinancing may not be an option. The market is punishing the vulnerable and rewarding the prepared. Conclusion: the end of easy money. CarMax's collapse is more than a stock chart anomaly. It's the canary in the coal mine for the entire used car market. The era of easy money, lawn loans, and sky-high prices is over. What comes next is a painful reset. Defaults, repossessions, dealer failures, and shifting power back to cash buyers. For consumers, it's both a warning and an opportunity. For the industry, it's a reckoning. And for CarMax, the company that was supposed to have all the answers, it's a reminder that no algorithm can predict the bottom when the entire market is sinking.